So hello everybody, and welcome to chapter 15 on debt and taxes. There are approximately 110 slides or so, or 109 in this chapter, and I'll break this up into small bites so it's not one continuous audio file. The first thing, this is on debt and taxes for corporations and also for personal debt and taxes. And everyone knows that corporations have to pay taxes, right, on their profits. And the nice thing is, basically, if they have debt, companies will use debt to pay out interest or coupons to the bondholders and be able to write those off, and thus they will lower their basically the amount of corporate taxes on their income. So that's one of the big reasons for using debt. They have an incentive to lower their tax base. So here is an example, and this is on your book on page 520, and they show basically the interest tax deduction for Macy's with or without, I believe, leverage being the use of debt. And as you can see in this next slide over here, here's the case where they basically have leverage, and they've got interest expense here of about $400 million and no interest expense here. And you'll notice their net income is much lower here than it would be without the leverage. But many times you'll find out that they issued less shares of stock by taking a leverage. So basically in all, the net income will go up, or the earnings per share will rise, since they used debt and they use less shares. So but the interesting point is that overall it makes more sense to use the debt. You'll notice, as I said, the value of equity went down with leverage. But when you look at all the investors, including the debt holders, there's an extra $400 million that wasn't paid. There was interest paid, and you'll notice here that the with the leverage, $1.96 billion was paid out with the leverage. So in effect, the total to all the investor was higher than without the leverage. So as I said here, with the leverage, Macy's paid 1.96 billion, and without the leverage, they paid out $1.82 billion. So the question, of course, and the simple question is, where does this extra, the difference of 140 million come from? And basically that's what's called the interest tax shield. So if you take the 35% corporate tax rate, as I've shown here, times that $400 million in interest, basically you'll see there's an extra $140 million, and that's known as the interest tax shield. Here's the interest payments, and basically this is the important equation that we all have to know. I'm not very good at drawing a straight line here, but whatever. So the important thing is this is the interest tax shield. All right, so here's a couple. They show a couple examples in this slide of using debt and interest to pay less taxes, and they do it for 4 years. And you can see here from 2012 to 2015, and here's the 4 years in question, and here's the interest expense on the debt. So you can see basically that they subtract that off, and you'll notice that the higher the interest expense, the lower the taxes they have to pay on the total amount. So the net income will drop accordingly. But basically your taxes go down, and here is your net income with less taxes. I should say the net income actually goes up, right? I didn't mean to say it goes down. So as you can see, as I'm subtracting off the interest expense, I pay basically less taxes. And that's the whole thing. And again, this is very similar to the concept of when you pay your property, you pay your mortgage, right? You basically write off your interest deduction as well as your property taxes. All right, so here's the example of that, and here's the interest tax shield, and this is in millions of dollars, and this is just a carryover from the previous slide over here. So 50, 80, 100, and 100. I believe this was what the Macy's example. And here they are, right? That's the numbers that came right from here. And these are just carried over to the next slide. All right, so in any case, those are over here. And just here's an alternative example of that. And you can basically see their interest tax shield over here based on the numbers. This is the interest they paid. Times, and they basically were able to write off 40% of that. So you could see that clearly in this example here. So here's the interest expense, and here's how much they were able to write off. 40% of that, or $2.14 million. So you clearly see, and this makes sense, right? Using debt, you have a corporate tax benefit each year, and this benefit is computed as the present value of the stream of future interest tax shields that the company will receive. And as you will remember from present value, you can get the value of the stream, right, as the present value, as we did with when we valued stock dividends. So this is an important point here, as you, which is similar to a present value of a bond. It was a very similar concept. All right, so basically what we see here and what we saw is, in a general sense, the cash flow of a levered firm, which is a firm with debt and basically paying with an interest tax shield, is going to be higher than they would be without leverage by the amount of that interest tax shield. And this is, of course, if we take into account the interest tax shield due to the bondholders. So here's the cash flow to investors with leverage. Here it is without any debt or without leverage. And here's the interest tax shield. So here's a simple example of that. Here is the unlevered firm with no debt, right? So here we are, unlevered, and there's no tax shield. And here they are with the interest on the debt and the levered earnings. And basically, here's the taxes they pay. And right over here is our interest tax shield, which is protecting us from paying higher taxes. So that's basically all you have to know about that, and it's pretty obvious. Taking companies like debt for that reason, but not too much, because eventually what'll happen is the analysts will catch on that they have too much debt, like Sirius did, and they'll get rated to junk. So here is the Miller-Modigliani proposition, but including taxes. And all this is saying is the value of a company is equal to the unlevered value plus the present value of the interest tax shield. So we have this levered value that includes this interest tax shield, which we saw from the previous slide with that chart. So this becomes important here for that purpose. All right. So all these equations pretty much say the same thing. And this is basically a graphical representation of that equation right there. All right. So if we look at this example here, here's a company that plans to pay, and this is from your book, $100 million in interest each year for the next 10 years. And then they're going to repay the $2 billion that they borrowed in year 10. And basically they consider the payments risk-free, and which is a simple assumption. And the tax rate, their marginal tax rate is 35% through that period. And this risk-free interest rate is 5%. So the question is, how much will this increase the value of this company, DFB? And it comes down to the interest tax shield is $35 million a year. And this is a 10-year annuity, as you can see. We just simply take 35 times 100 million, 35% tax bracket. So it's 35 for the next 10 years. So everyone should recognize this as an annuity, as they basically say here. And because the tax savings are known and there's no risk involved, we discount them at that risk-free rate. And here's the annuity at 5%. And that present value of that interest tax shield is $270 million. And we don't include the final, I believe, $2 billion payment into the tax shield. So we have basically a $270 million value tax shield that we add, that gives us the present value of the what the tax shield is worth. All right, I'm going to cut off here because this is about 13 minutes, and I'll pick up on the next slide on another video. All right, see you later.